Hello and welcome to our October 2024 market update. Let's roll them, Max.
I'm Max, this is Victor. Alright, so our underlying thesis, 90% of the things you worry about never happen. Number 2, we make observations, not predictions. Number 3, the simplest explanation is usually the best one, that's Occam's razor. And finally, number 4, economics 101. Supply and demand applies to most markets as well as most products. Alright, so how are the markets doing? Vic?
Looks pretty good. The Dow, remember this is 10 months. The Dow's up a little over 12, almost 13%. The S&P 21%, and the Nasdaq Composite, 21%. And wasn't there the S&P 100?
Yeah, the S&P 100. So if you look at the second circle, the line right below that is the S&P 100 index. That's up about 25%. So that's the 100 largest companies. So as you can see, the larger companies are outperforming the smaller companies.
Yep.
All right, so let's go to the charts. The Dow Jones.
All right, Dow Jones Industrial Average. This is a chart for the last year. This makes a really quick visual illustration. You don't have to be a rocket scientist to do what I'm going to ask you now. You see the two lines we've highlighted. The 200 DMA, daily moving average, smooths out, covers a year. The 50 daily moving average basically covers a quarter. And Max, if you look at those two trend lines, are they down, sideways, or up?
They're up. They're going up, up.
Now, S&P, you tell them what's happening with the S&P.
Same with the S&P. We have the 50 and then the 200 day, and those are moving up as well. And then we have the NASDAQ that correlates that as well.
We are in a confirmed long-term secular uptrend.
Bull market.
A bull market. I'm going to do this one, okay?
All right, give us the perspective.
I want you to look at this and think about this, and we're going to come back to this. Here we go. An editorial. It is a gloomy moment in history, not in the lifetime of any man who reads this paper has there been so much grave and deep apprehension. Never has the future seemed so dark and incalculable. The domestic economic situation is in chaos. Prices are so high as to be utterly impossible. The political cauldron seethes and bubbles with uncertainty. The United States is beset with racial, industrial, and commercial chaos, drifting we know not where. Russia hangs like a storm cloud on the horizon of Europe, dark and silent. It is a solemn moment, and no man can feel indifference. Of our own troubles, no man can see the end. We'll come back to that, and you'll see why. Income and yields, all right, Max?
All right, so the current rate for the 30-year bond is at 4.5%. As you can see, a year earlier, the 30-year bond, you can see that chart on the right-hand side, is up over 5%.
And in 1 year, we've gone from 5 down to 450. And there's probably a trend coming up.
Yeah, a little bit of a trend. All right, so the current yield curve. Like Victor said, we've gone from 5 to 450. So this is the current, is the blue, and the black is 1 year. But as you can see, it's starting to go down. We had an inversion, an inverted yield curve, which the lower end is higher than the longer end. So that makes an inversion in the yield curve.
Yeah, and you can see starting at 5 years, it's starting to go back normal, meaning normal means the longer you go out, the higher the rate. Look at the blue line right now over to the far right. The short-term money, a short-term treasury, a short-term CD, is higher than at the opposite end, the 30-year. And is there a reason for that, Max?
Yeah, they want money in the market, and they think interest rates are going to go down, right? So if interest rates go down in 1 year, the banks can say, okay, now we can restructure that debt at a lower rate.
Yeah, they want you to buy. They want you to buy the 1 year rather than locking in a 5 or longer, so that in a year from now, when the money matures, guess what happens to your rate and income?
Lower.
You got it.
All right, so what's going on in bonds? Investors embrace the bond funds before rates start to fall. So we have such a thing called, we use is a seesaw.
I got to get these right, okay?
A seesaw. So when rates go up higher, the prices go down. When the rates go lower, the prices go up. So for these bond funds, if you're a mutual fund holder and you hold some of these bond funds, you might be starting to see the returns and the values going up.
And the bond fund managers are doing exactly what we just talked about. Instead of buying short, they realize short rates are going to go down quick. They are extending maturities to lock in the higher rates for longer.
Correct. So, building wealth for retirement income. What is income investing?
Income investing is simply a strategy focused on generating regular, predictable income that you can live. Now you're at the point where the money works for you rather than you working for the money. So what is the goal of doing that?
The goal is to generate a steady income stream and to preserve and grow capital to keep up with inflation.
And remember, you gotta beat inflation just to break even.
Oh, all right. So, Vic, what are some of the type of investments?
Here's the different types. We won't go into depth in everything, but you have to do a combination of things. The gray area are real estate investment trusts. That's real estate property, and we'll talk about that in a minute. Traditional bonds, you have corporate bonds, you have tax-free bonds, you have treasuries, and then finally dividend stocks. You don't put it all in one area, but between the three of them, you diversify and optimize for both income and for growth.
Correct. All right, so transitioning your portfolio. The taxation of income investments. You have interest income, which is taxed as ordinary income, such as bonds and rates. Then you have qualified dividends, which is taxed at a lower capital gains rate. And then you have muni bonds, which is generally exempt from federal taxes. So asset location strategies, they place taxable income generating assets in taxable tax advantaged accounts such as
Like
IRAs and
yep.
401ks, 403bs for teachers. Then minimizing your tax impact. So plan sales to manage capital gains taxes. Use deferred accounts to grow investments without immediate tax liabilities.
Go ahead.
So we do a tax actually strategy. We've talked about it before. If you send us your taxes, we can figure out a strategy to optimize lowering your tax rate.
You've got to maximize. And remember this, when you retire, you go from the accumulation stage, you're accumulating money, to the distribution phase. Whole new set of rules. One of the things that's very important is we work to minimize your taxes and take things out in the most tax efficient manner.
Correct. All right, so we talked about the Federal Reserve Board is lowering their interest rates. They already did a 50 basis point cut. How does that affect you? So lower interest rates benefit income generating securities.
So does that mean rates go down and prices go up?
Yep.
There we go, okay.
And then reduced borrowing costs allow companies to grow dividends. And then dividend stocks and utilities and REITs perform well in low interest rates environments.
And that's exactly where we're going.
Exactly.
Do you have any examples?
Yeah, we got a couple examples. We got Dominion Energy, Verizon, and Prologis. All right, so why AI matters to income investors.
Wait a minute, what's AI?
Artificial intelligence.
There we go, all right.
All right, Vic, you want to do this one?
Artificial intelligence. We're seeing we're going to go into that map in a minute, but it's a combination of things. They need reliable fuel. They need reliable water. We'll tell you why in a minute. They need more generation. An AI computer needs how many times of a regular computer?
10 times.
10 times the power. All right. See all the blue dots you sort of see on each coast? Those are data centers. We'll talk about that in a minute.
All right, so 3 Mile Island's coming back to you. AI is bringing back 3 Mile Island because it's cleaner. Victor just briefly spoke about this. Microsoft is teaming up with the company that owns the 3 Mile Island to create newer energy because we need it for AI and for growth. It's 10 times. We need 10 times more of the energy. And nuclear energy is cleaner, and it goes 365 days a
Absolutely.
year, 7 days a week, 24 hours a day.
Here's the key on this fuel for the electricity. It has to be reliable 24/7, 365. You can't do it with wind. What do you mean there's no wind today? I can't compute. Can't do it with solar. Oh, it's cloudy. I guess we'll turn off the computers. It has to be fossil fuel and nuclear. Okay, what are the data centers?
So there's a growing demand for data centers. As you can see, this is Virginia. So there are 475 data centers.
Wait a minute, how many in Virginia?
475 data centers.
That's a lot of data.
Yeah.
Okay.
And so AI growth fuels demand for data centers to handle a massive data storage and computation. Data centers are energy intensive and require robust infrastructure. Examples are Digital Realty Trust and Equinox. So, Victor, talk about The
Okay,
growing
here's
need?
the same thing. If you look at that chart on the lower right, you see the bar chart going up. That is Dominion Resources estimate for their growing power demands over the next, I think that just goes to 2027. Here's the deal. Traditionally, dividend paying utilities, the rate of growth is based on population growth. It's electricity. However, we have had a paradigm shift in the demand for utilities because of AI, which is now going into everything and generates the huge need for power. All of a sudden, these electric companies are saying, we're growing like a growth stock.
Yeah.
So it's unbelievable.
So it is a bright future for dividend stocks because of those reasons that
Absolutely.
Victor talked about. All right, so the election season, it's 2 weeks away.
Oh my God. Okay.
All right. So how is it done? Average return for the election season is about 11.5%. For Republicans, when a Republican is in office, about 15%, and when a Democrat, about 8.5%. Either way, it's great.
Absolutely. And here is the key, because a lot of people go, oh my God, I'm going to wait till after the election. Don't worry about the election. And we're going to tell you in a minute why it's time in the market, not timing.
Exactly.
But here is the key. The president is more dependent on the economy than the economy is on the president. No matter who's president, you still go out and buy, you fill your car with gas, you go buy food, you buy presents for your grandchildren or your children. You spend money regardless of who's in the office.
So, as right here is a perfect example. Victor, if you put $10,000 in when John Kennedy was president, where would it be now?
Look at that chart on the bottom. You see, it goes $10,000 today, $5,119,518. Not bad.
Not bad. It's
So-
time, like Victor said, it's time in the market, not timing the
Absolutely.
market.
The interesting thing is, if you look over there, almost there's two times that it went down. The first one was,
Nixon,
yep. Second one was,
George Bush.
and what did George have to deal with?
George had 9/11, and then he had the dot-com bubble.
He had a rough time.
Yeah.
Okay.
So, tie it all together, Vic.
Let's go back to this. Remember this. And I'm going to read it again to make the point. It is a gloomy moment in history, not in the lifetime of any man who reads his paper has there been so much grave and deep apprehension. Never has the future seemed so dark and incalculable. The domestic economic situation is in chaos. Prices are so high as to be utterly impossible. The political cauldron seethes and bubbles with uncertainty. The United States is beset with racial, industrial, and commercial chaos, drifting we know not where. Russia hangs like a storm cloud over the horizon of Europe, dark and silent. It is a solemn moment, and no man can feel indifference. Of our own troubles, no man can see the end. That's what we're facing today, and you go, I don't know what to do. I'm afraid of the future. I can't believe we can go through all of this, and I don't know how we're going to survive. Now, what's the key to this, Max?
This was October 10th, 1854, almost 170 years ago to the day. Yeah.
That opinion and that set of circumstances was October the 10th, 1854.
Wow.
Wow. I think we survived, didn't we?
Yeah. All right, so why timing the market is so difficult? So, as you can see, all of these ups and downs. So, on the far left, we had a 16% change, 5,600 points. Then an 8% change, then a 2% change, then a 9% change. You would have to get all of those buys and sells correct in order to have an up year of 13%.
So in order to beat the market, my timing, instead of staying in the market, I had to make, let me see, 1 buy and sell, 2 buy and sell, 3 buy and sell, 4. I have to make 8 correct moves and decisions and get my timing right. However, if I had just stayed in the market, time in the market, I would have ended up with
almost 14%,
which is
not a bad return.
Absolutely.
So, raise cash or buy the dips. Here's the 82-year review. We've talked about this before. I remember Victor and I giving the update of how long bear markets and bull markets are. These huge mountains, those are bull markets.
The big blue?
The big blue.
Yep.
Bull markets. The big orange, the little orange,
little
orange are bear markets. So, how long have they lasted?
The average bear or down market lasts less than a year, 11 months, while the average bull market,
6.5 years.
1
Wow.
year versus 6.5. And we're in the beginning stages of a secular bull market.
So, our conclusion, the saying goes, it's time in the market, not timing the market. Vic?
Yeah, to time it, as we said, you have to have multiple sell and buy decisions. Sell when it starts to go down, buy when it starts to go back up. And you have to be right on all of them.
So we just reviewed the 1 month analysis, the year analysis, and the 82 analysis, year analysis.
Still makes the point. Conditions today are arguably better than last year. We're looking at slowing inflation, lower interest, and a huge technological boom. Our conclusion?
October can be difficult, but history leads to our conclusion. Stay invested and buy on the dips. So we provide a historical perspective. We take the emotion and replace with historical context. Why does history repeat and so many fail to learn?
Times change, but human nature does not. So, thank you for joining us today. And as always, remember,
We're here looking out for you.